Let's read the requirement first. This is a March-June 2024 question. It's a question number 3. So analyze the suitability of Pilzer and Garnod Co as possible takeover targets for the Garnod Co. So analyze the suitability of P company and M company as a possible target, a takeover target for the G company. No calculations are required for part A. So we need to discuss whether it's a suitable company to acquire or not. Okay. B part. Calculate the minimum price which P company shareholder are expected to accept. We will calculate the current price and we will add the premium into it. Normally, whenever you are trying to acquire any company, they give you their minimum price. It would be written somewhere in the question. The target price which G company would pay based on a free cash flow to equity valuation on the basis of 60% of the gain from the acquisition accruing to its shareholder. So I am assuming from the given requirement that G company is an acquirer. So we will calculate how much the G company will pay to the other company, assuming that 60% of the benefits G company will take. So we will calculate the synergy, total synergy, and will distribute 60% of the synergy to the G company. So the remaining would be the amount you will be paying to the other company. So only the terminology is different, but the calculation is same. Third, percentage of gains from the acquisition, which would accrue to the G company shareholder if G company paid the minimum price, which P company shareholder are expected to accept based on free cash flow to equity valuation. The percentage of gain from the acquisition, which would accrue to the G company if G company paid the minimum price, which P company shareholder are expected to accept. In the previous part, it was the question. In the question, it is stated that G company will only accept 60% gain. Okay. But maybe the P company is not agreeing to it. So if you pay whatever the P company is demanding, what would be your gain in that case? No discussion is required for part B. Discuss the feasibility and effectiveness of the defense strategy suggested to fight a takeover bid for Pilzer company. So defense strategies would be given in the question and we have to discuss those. Professional marks will be awarded for the demonstration of skills and analysis, skepticism, and commercial acumen in your answer. Okay. So in B part, normally whenever there is a numerical part, we normally discuss it. But here, we will not discuss it because it is given, no discussion is required. Okay, this is a disclaimer. So lots of data is given, although it's a 25 marks question. But lots of data is given. G company was established 12 years ago to provide courses for accountancy qualification. This is a question related to I think our business. A major reason for G company's success has been that it has been quicker than its competitor to develop profitable e-learning course packages. So they are quicker in developing e-learning course packages. Apart from its founder, G company staff turnover has been quite rapid. Okay. Some staff have not stayed long, either because they are ambitious staff who have made a contribution but sought career progression elsewhere, or because they have been quickly dismissed. So this is a problem. We can discuss this in part A. Because G company is a company where staff is not staying. Okay, G company was listed 3 years ago. The founder founded it 12 years ago, but it has been listed 3 years ago on its country stock market for smaller companies. So normally in every country, in every major country, there are two types of stock market, one for the bigger companies and one for the smaller companies. The smaller company stock market is not that liquid. Means there's not enough liquidity, buyer or sellers are available. It is difficult to buy and sell shares in small market. Still, it is better from the private, but not better than the public listed, typical public listed company. It has since developed governance mechanism in compliance with stock market regulation. Some of its non-executive directors and investors feel that its culture is still too informal for a listed company. We do highlight this. All of these can be useful in part A. The G company executive directors are looking to expand the company to new areas of training where there is a potential for cross-selling courses. Cross-selling. You are doing accounting, so you want to acquire a company where you can cross-sell your courses and further opportunities for development of e-learning packages. G company board has identified two possible target company, Pilser and M company. Okay. So plenty of data is given. By the way, I'm taking long time to read it. More time to read it. But obviously you can read it quickly. Pilser company has offered classroom courses for legal qualification and professional development areas. Classroom courses, not the online. Pilser company is also listed on the smaller stock exchange market on which G company is listed. For a long time, Pilser was a leading company in the area of legal training, and its director and some staff have been with the company for most of its life. So this is a differential between these two companies. Here, people want to stay longer. The company has a well-defined management structure with seniority and classroom experience being important attributes required for promotion. However, in recent years, revenue and profit growth has been slower than the G company because of the increased competition and Pilser failure to develop the e-learning products. This is important. Okay, G company number of shares and Pilser number of shares are given, share price is given, free cash flow to equity is given. Additionally, P company equity beta is given, asset beta is given, expected growth rate in the P company equity is given, current risk rate is given, market risk premium is given. G company finance director believe that acquisition could generate annual 9 million of free cash flow synergies. So free cash flow synergies are given. The multiple of free cash flow to equity is 8. There were 2 questions in the past paper for this type of question. So free cash flow to equity multiple is given, that is 8 for G company before the acquisition and can be assumed to increase by 5% for the combined company. So you will calculate combined company valuation using free cash flow to equity model. There are different models to calculate combined value. Combined PE ratio, combined WACC, total synergy, and this is free cash flow to equity. The finance director believes that P company shareholder would at a minimum accept a 14% on the current price of its shares. Although she thinks that shares may be overvalued at the current share price. So they are assuming that they will take 14% premium, not on the calculated price, on the current price. And the free cash flow equity valuation should be used instead. Okay. G company board has set a target of 60% of the gains on the acquisition. Okay, what is defense? Pilser company director are aware that G company may be interested in acquiring their company. The director would not welcome a bid from the G company as they feel that it would result in major changes to how the company operates and threaten their own job. Technically, Pilser company directors are not behaving right. They should behave from the perspective of shareholder. So they want to save their own job. Okay. They want to save their own job. 2 possible defense strategies have been suggested. One is seeking an alternative, more welcome bidder for Pilser. It's kind of a white knight. You will ask your friend to acquire your company. The other is Pilser company making a counter offer. Kind of a Pac-Man defense. You are acquiring me, I will acquire you. Okay, there's a very good question, sir. How do you know that we will solve question with free cash flow to equity? देखो, look, you have to read the question carefully. When I read this question, like whatever appearing in on the screen, only thing which is written free cash to equity, multiple of free cash to equity. So nothing is written about earnings, price earning ratio, price to book ratio, free cash to firm, WACC, nothing is written. Only one thing is written, free cash to equity. So we use, okay, that's why you will use that model. The last is M company. M company is an unlisted company which is smaller than G company. The company was founded 5 years ago by husband and wife, Richard and Katie, who owns 80% of its share capital between them. The company provides professional development training in areas such as management and personal skills. Also training in legal requirements such as health and safety. So is it linked with accounting? Management and personal skills are somehow linked with accounting. Richard and Katie have recruited lecturers whom they feel will work well with them and have given lecturers considerable autonomy in delivering courses and gaining new work. The board consists of Richard and Katie and 2 other lecturers, but in practice, Richard and Katie make all the major decisions. Okay. M company revenue and profit have increased in the last 2 years at a greater proportion rate than the G and Pilcher company. It's a good thing. M company has developed a limited number of computer-based courses, but has had insufficient funds to develop the significant in-house e-learning capability. So they have the potential to develop it. They can develop it. Richard and Katie have indicated that they are willing to discuss a bid with G company. So they are more open. They are more open. So let's solve the B part first. Minimum price that Pilcher company shareholder are expected to accept. So which model we should use? Free cash to equity model, it is written. Right? It was written somewhere. The finance director believed that Pilcher company's suggested shareholder would at minimum accept a 14% premium on the current price, although she thinks that share may be overvalued and the current share price and the free cash flow to equity valuation should be used instead. So let's calculate their current value. Okay. Part B, first part. Minimum price which P company shareholders are expected to accept. So what is the free cash flow? All figures are in $1 million. Equity. Okay, free cash flow equity of Pilcher is 70 million. Right? And growth is, what is the growth? 1.5%. Cost of equity you can calculate. Risk-free rate is given. 3.8%. Beta equity is given 1.4. Risk premium is given 8%. So cost of equity is risk-free rate plus beta into risk premium, 15%. Okay. Valuation would be only one growth is given. One growth, one cost of equity, and free cash flows are given. So you will apply a single growth mode. 70 into 1 plus growth divided by cost of equity minus growth. So that's the answer. That's the answer. 526 million. 526 million is the valuation based on free cash flow. Okay. Now, what is the minimum price that Pilser will accept? Based on free cash flow valuation. Based on free cash flow valuation. What is the premium they are demanding? 14%. So we will load 14% premium to that. $1.14. Approximately 600. But the problem is they are not demanding premium on their free cash flow price. They are demanding on the current valuation. On current valuation. If you look at the wording, yes, the finance director believed that Pilser company shareholder would, at a minimum, accept a premium of 14% on the current price of its shareholder. So what is the current price? 5.4. 5.4. So current value is 100 million shares into 5.4. Premium 14%. So technically they are demanding this. They are demanding 615. So this is the answer. So why you have calculated above? So that you can compare. Because you are thinking that this is a bit overvalued. Actual should be this. So this is the answer of the first question. How much they are demanding? 615. Okay, what is the next part? The target price which company would pay based on the free cash flow to equity valuation on the basis of 60% gain from the acquisition accruing to its shareholder. So how much G company is willing to pay? How much G company is willing to pay? So we have to calculate the synergy. We have to calculate the synergy. Premium is very simple. It is written in the question that the minimum price which Pilser company shareholder expected to accept. If you look at the information, the shareholder, read this, the finance director believes that Pilser company shareholder would, at a minimum, accept a premium of 14% on the current price of its shares. On the current price is 5.4 per share into 100 shares, 540 million, load 14% on 540 million. So this is the minimum price they are accepting. Sir, why you have calculated above? For the time being, leave it. I will explain it. Okay, this is the answer of first part. Second, the target price which G company would pay based on the free cash flow to equity valuation. On the basis 60% of the gains from the acquisition accruing to the shareholder. Okay, there is one more way of solving this. That's it. This is the answer. The minimum price which Pilser company shareholder are expected to accept. Okay, I'm acquiring your company. What is the minimum price you will accept? You are saying that I will take 14% premium on my current valuation. So your current value is 540, premium is 14. So the minimum price which you accept, that is 615.6 million. This is the minimum price which you will accept. Okay. Now, I have to do it again. The target price which company would pay based on the free cash flow to equity valuation on the basis 60% of the gains from the acquisition accruing to the shareholder. So if I simply think what the examiner is asking, examiner is saying that calculate the gain on the acquisition. 60% gain will, the acquirer will take 60% gain, 40% gain will be given to the target company. Okay. So let's calculate the gain in acquisition. What do I mean by gain in acquisition? Synergy. Gain in or synergy in acquisition. How to calculate it? Combined market value minus market value of Pilser minus market value of the other company. Market value of G company. Okay. What is the value of G company now? And what is the value of Pilser? Let's calculate everything. Let me calculate combined market value first. First of all, calculate combined free cash flows. Free cash flow to equity. Okay. FCFE of this company, FCFE of other company, and synergies. Cash flow, synergy. FCFE of G is 60, Pilser is 70, and the synergy is 9 million. 60, 70, 60, 79. $139 combined free cash flows. Okay. What is the free cash flow to equity multiple? The multiple of free cash flow to equity is 8 for parent company before the acquisition. And it can be assumed to 5% after the combination. So price to FCFE for G company, 8. Price to FCFE after acquisition, post acquisition. It will increase by 5%. So you have the combined free cash flow. You have the price to free cash flow. So let's calculate the combined market value. This into 139. So 1168 is the combined value. Okay. Now let's calculate the market value. Combined value is given. We have calculated the combined market value. What is the value of the G company? G company price is 6 into 80. Or you can also solve using the free cash flow to equity multiple. 60 is given and 8. 60 into 8. In both cases, it would be 480. 480. What is the value of Pilser? Now you need to calculate the value of the Pilser. Sir, it is given. It is 6. Pilser value is 5.4. 5.4 is overvalued. Free cash flow to equity valuation should be used instead. Director is saying we should use the free cash flow to equity valuation. Okay. Assuming current value is overpriced, value based on FC, FE. Okay, FC, FE is given. Growth is given. Risk-free rate is given. Beta equity is given. Risk premium is given. Free cash flow is 70 million. Growth is 1.5. Risk-free rate is 3.8. Beta is 1.4. Take beta equity. Only in APV we will use beta asset. So cost of equity is 3.8 plus beta into the premium. 15% K. So value based on CFP. 70 into 1 plus growth divided by cost of equity minus growth. So this is your valuation. Technically, this is your valuation, 526. Okay. Now put 526 here. Now let's calculate the synergy. Combined value minus the individual values. 161. Synergy is 161. Synergy is 161. And the question is stating 60% of the synergy will be taken by will belong to the parent company. And 40% to Pilser company. Okay. So requirement. The target price which G company would pay based on the free cash flow to equity valuation on the basis of 60% of the gains from the acquisition accruing to its shareholder. How much you are paying? So you are paying 64.52 premium on the price. You're paying this. 590.81. So you are paying target price 590.82. Okay. But how much they are demanding? They are demanding 615 and 0.6. Minimum price demand by Pilser. So the question is, the percentage of gain from the acquisition which would accrue to G company if G company paid the minimum price which Pilser company shareholder are expected to accept based on the free cash flow equity valuation model. So just assume that if the Pilser company says we don't need 590, we need 615, then how much gain will be accruing towards G company? So let me calculate the gain overall. If paying above minimum price. Okay, total value is 168 minus, this is your own value, minus, now you are not paying 526 and the gain on this, you are paying 615. So gain of company will be 72 instead of 96. And percentage gain would be 72 divided by the previous value of the G company, 15%. Sorry. 72 divided by 16, 15%, or how much of the total proportion gain? 72 divided by 161. So out of 161, you will be getting 44% gain. Previously, you were aiming for 60%. Previously, you were aiming for 60% gain. So what is happening actually? Question was not that difficult. Question was very simple. What is the minimum price which Pilser company shareholder are expected to accept? They want to have 14% premium on their current price. Their current price is 580 million. Sorry, what was the price? Current price was 540 million. And we load 14% on that. So there, they will demand 615. Okay, fair enough. But we are thinking, just think about our perspective. We are the G company. We are thinking that this price is overvalued. This is overvalued. Let's do all the calculation on the free cash flow to equity. Okay, we have calculated free cash flow to equity, that market value is 526. Okay. And our combined value is 1168. We deducted 1160. We deducted 526 and 480 from 1168. Our gain is 161.3. Okay, 60% gain we will keep the 60% gain, and 40% we will distribute to the Pilser company. Okay, the question is end, but just assume if Pilser company will just try to understand the concept of the Pilser company. Pilser company is saying that we will not accept 590. How come you how you have calculated 590? 526 plus 64. They will say, no, we are not accepting 590. We will take gain on our current price. We will calculate gain on our current price. Current price is 540. We will demand 14% premium on this. We will demand 615. We will not take your 590. Okay. In that case, what will happen? In that case, The G company gain would be only 72. That is 44% of the total gain or 15% gain on the valuation. That's how you will solve this. Yeah, this is post-acquisition value, right? Post-acquisition value. And these are pre-acquisition value. Pre. This is also pre-acquisition value. You can also solve using your table format. But to be honest, that will take more time here because the question is not that lengthy. Try to understand it. I want to acquire your company. You are saying that, okay, we will demand 14% on our current value. What is your current value? 540? 14%. Okay, if I load 14%, that is 615. Okay. Now I am calculating combined value based on free cash flow. That comes at 1168. And I think your value is greater. Your free cash flow to your valuation based on free cash flow model is less. So if I calculate your valuation based on free cash flow, that is only 526 instead of 540. So I am assuming I will pay you 526 and plus 40% of this gain. So your target price is 590.82. I will pay you 590.82. But what if you don't agree, then I have to pay 615. So if you agree, my gain would be 96. If you don't agree, my gain would reduce to 72 because I have to pay you additional amount. Okay. Got it? 161 includes everything. That 9 million synergy is on per year. This cash flow synergy is per year. It's not a 1 year synergy. So I have added that 9 million in the free cash flows, calculated the combined free cash flow, multiply it with price to cash flow ratio. Okay, 9 million is included. Okay, then there was one more question. One of the students is saying, sir, we often get confused when we have to deduct the premium, when we have to deduct the risk-free rate from the premium and when not. There is a two-liner answer. Whenever the word premium is given, that means it's always adjusted for risk-free rate. It has already been, the risk-free rate has already been deducted. And if the word return is given, market return, that means you have to deduct the premium. You have to deduct the risk-free rate. Very simple. And if you found any question contradictory to this, please show me. This can never be, there can never be a contradiction to this statement. If premium is given, risk-free rate has already been deducted. If return is given, you have to deduct the risk-free rate. That's it. So discuss the feasibility and effectiveness of the defense strategies. Okay, what was the two defenses? One is seeking an alternative, more welcome bidder for Pilser company. First defense is similar to white knight defense. Pilser company is pursuing to other friend company to acquire majority of stake in Pilser to avoid acquisition from G company. Okay. There is an issue with this strategy. This is not the best practice according to acquisition regulations, acquisition framework. Acquisition framework. As Pilser company directors are not acting in the best interest of if its shareholders. They should take permission from their shareholders to accept or to decline the offer. They are more interested in saving their jobs instead of evaluating the offer, evaluating or negotiating the offer of G company. Okay, right? Okay. Pilser is trading on alternative market instead of main market. In alternative market, stock prices are usually normally not liquid. And it will be difficult to find suitable friend company who can put huge investment in Pilser company, right? It would be difficult. Alternative market is, look, in every country, in every major country, like in UK, there are two markets. One is major market, where heavyweight, the big companies are trading. And on alternative markets, the smaller companies will trade. Only the small companies will trade. Like currently, I am in KSA. So in KSA, there are two markets. Tadawul, where all the big companies are trading, like Aramco, like Jareer, like the main big shots of this country. And there is a another market that is called NOMO. That is alternative markets. Only small companies are trading there. And you know the daily volume of that small companies are very low. 200 shares, 300 shares, 500 shares, 2,000, 5,000, 10,000 shares. But in main markets, millions of shares are trading on daily basis. So alternative market means a small market. So if your company is trading on small market, how can you sell your shares? It will be difficult for you. And a major concern, if this defense doesn't work, Pilser company shareholders will lose the bargaining power. And G company can reduce its offer price. Okay. And if you're still insisting that, okay, let's sell the company, then you will not be able to sell. The G company will lower the price. Okay. What was the second defense? Second defense. Second defense is more similar to Pacman defense. Okay, G, there is a point that, sir, can we write that through white knight, we can get the better price? The problem is, theoretically, you are right. Whenever we are going for the other bidder, we will get normally it is happen because to increase the price. But the problem is, you are not dealing in a main market. You are dealing in a small market. Your market is small. Stock market is small. Your shares are not trading on the main listed stock market. So nobody will give you a lift, to be honest. Nobody will bother to buy your company. It would become difficult for you to attract the company. And plus your company is in losses. Plus your growth is declining in the recent year. Pilser growth is lower compared to the G company. So it would be difficult for you to attract the friend company. You can write this point, but then you have to counter this point that this can only happen in a main stock market, not on small market. बात समझ आइए? Okay, perfect. Let's write the second defense. What is second defense? G company is trying to acquire your company. And in return, you are saying, okay, रुको जरा, क्या कहते हैं उसको, रुको जरा, सबर करो, we will acquire you. You are trying to acquire us, we will acquire you. So is it a good strategy? Is it a good strategy? This defense would be may be suitable if Pilser company found that Garnod is a suitable company to acquire. The growth of is higher compared to Pilser and is also have more powerful, is also have e-learning platform and experience. Okay. So if Pilcher acquired the G company, what would happen? We will acquire a better growth company, and plus we will acquire G company, which has a e-learning platform and experience. Pilcher can better run the combined business as they have experience of running business. However, they have to keep the management of G company to run the e-learning system. There can be certain issues with this defense. Pilser have to spend considerable time and cost to acquire the G company. The major issue is how to finance this acquisition. Okay. I will acquire your company, but how to finance? In share for share exchange, transaction would not be suitable for G company shareholders as Pilser is trading on small exchange. Although the G company is also trading on small exchange, but what is the benefit? They will not get the benefit. And for cash consideration, Pilser has to arrange cash to acquire it will put pressure on company liquidity position. Okay. Right. Sir, how do you know that Pilser has how to arrange Pilser? If you look at the beta of the Pilser asset beta is small, equity beta is larger. So that means Pilser has some debt. You can also write this point. that Pilcher has to arrange debt in order to pay this company, in order to acquire this company. This is also an issue. Okay. Because I don't think that share offer will be acceptable to the G company. Because what they will get the benefit. And Pilcher company has to pay more than their own value to acquire the company. Right? So you can write the advantage and disadvantage of the defense. Even for the above part, you can write the advantages, but then you can counter that. What is the problem with the defense? Now let's come to the A part. Analyze the suitability of Pilcher and M company as possible takeover targets. When you acquire the other company, what you will see in order to acquire the other company? If you have to acquire the other company, what points you will see whenever you are acquiring the other company? Anyone? Whenever you are acquiring other company, which point you will see? Income stream, excellent. Shareholder base, excellent. Investment opportunities, liquidity, culture, key employees, value creation. Okay. Let me write all this. First point you will see, okay, if I have to acquire, I have to choose two companies. So in between the two companies, what I will see? Which company is more aligned with my company? The word is strategic fit. Where acquirer objectives are more aligned. Okay. Obviously, we will explain, we have to explain this, but I'm just giving you the headings. Okay. Then value creation. Which is generating more value creation? More value creation for parent company, right? But you know only for the Pilcher company. For the other company, you don't know. And other one is synergy. Synergy is covered here, value creation. Investment opportunities, future investment and income opportunities. Okay, cultural integration. Okay. Another point, shareholder base. One student has written about the shareholder base. Shareholder base. Income stream, okay. Income stream. Shareholder base. Shareholder base. Product mix. Product mix or diversification. Both are linked. Now, nothing is given about the tax saving here. So it's better to avoid this tax saving. Okay. Any other point? So you are acquiring, you have to choose one company out of two. You will see which company is suitable to You will see the value creation or synergy benefit. You can write synergy benefits here. Or future income or investment opportunities, product mix, culture integration, shareholder base. Okay, now you will explain. Improve liquidity. Yes, you can write that how you will acquire the other company. If you have to acquire both companies using cash, then liquidity will not improve. Okay. Now let's compare every company. Whether Pilser is more strategic fit or the other company. Just identify. Pilser is offering classroom courses for legal qualification and professional development courses. Areas are law, tax, and regulation. Just think from the accounting perspective. Just think that we are offering ACCA, CA, CFA classes. So we will acquire the this law company, because if we are accountant, we can offer tax and regulation. Because the accountants are more into tax and regulation. And you know, majority of the accountants are also in the law as well. I have seen many accountants who have done the LLB. I think you guys know that there is one job opportunity you can do in future. You can do the taxing of other people, right? But what about the other company? Other company is more into management and personal skills and health and safety. So we can write the comments that the G company should acquire the Richard and Catty company because they are more into management and personal skills and health and safety courses. And they are also making a limited number of computer courses, although they are facing problem of insufficient funds. But if we have the funds, we can develop their system. The problem with the Pilser is only offering classroom classes and offering the legal qualification. We can start the legal courses by hiring our own employees. Income stream is more for the M company. M company profit and revenues had increased in the last 2 years. So for income stream, M company is more suitable. Pilser is not suitable because Pilser growth and revenue are slower than your own company. Okay, what was the next point which we have written? Value creation. We know the half story of value creation because the calculation of Pilser is given. In Pilser, we are making money, some 64 million or 72 million, 72 million, 96 million. But for M company, it is not given. It depends that how we need more information, that how much we have to pay M company in order to identify the value creation. Cultural integration is a subjective term. If you acquire the Pilser company workers are working there from many decades. And M company have few employees. So it is easy for you to acquire the M company and integrate with them. And M company, Richard and Katie both can be on the board. They both can do the offer the courses. Okay. Okay. What about the shareholder base? Pilser company is a listed company. Catty company, Richard and Catty company is a private company. So it's easy to acquire the private company because you only need to convince Richard and Catty. Right? You will get the 80% shares. But for the Pilser, you have to take the stock market permission. It is difficult to acquire the stock market listed company compared to a private company. Private company is easy to acquire. Product mix and diversification. Product mix and diversification benefits you can acquire from both Pilser and Catty. But the problem is you will acquire that company where management of that company is willing to enter into e-learning system, because the future is of e-learning system. So either if the Pilser company will show the willingness that they are going into the e-learning system, then you can acquire the Pilser. Otherwise, it is better to acquire the Catty company because they are more into, they are already into the e-learning system also, although they have developed the limited. But the problem is they don't have the funds. That's why they have developed the limited system. Okay, this answer can be subjective. I think from the strategic fit perspective, Catty is more suitable. From the income stream perspective, Catty is more relevant. From the shareholder perspective, it is easy to acquire the Catty company because there are two shareholders. From the value creation purpose, we don't have the enough information. And for the product mix and diversification, Pilser is offering law services. Pilser is offering only law services. But the Catty is offering personalized training. So you can't offer personal training easily, but you can offer law training easily. Okay. So we do not need to give the conclusion. We only need to discuss that according to these points, which company is more suitable. In question number 2 and 3, there is also always a 5 marks for professional marks, 5 marks for this professional skill. In question number 2 and 3, he can test the 3 skills: analysis and evaluation, skepticism, and commercial acumen. Okay, let me end this misconception. Students always think that we have to always obtain marks from commercial acumen, skepticism, and analysis and evaluation. No. Examiner will test a mixture of this. In every question, there are marks available for analysis, there are marks available for commercial acumen, there are marks available for skepticism. Maybe your answer is excellent. You can get more marks in professional skills, but the problem is examiner only give you 5 marks. Maybe आपके marks 6-7 बनते हो, but examiner will give you only 5 marks. But if you unable to apply any skill, you will get 0. If you only apply 1 skill, you can get 2 or 3 marks. If you able to apply 2 skills, maybe you are getting 5 marks. Okay, it's not that you have to apply all the skills. Try to apply all the skills so that we will be on a safe side that we are getting 5 marks. But if you apply 1 or 2 skill, you still get the marks. Maybe you get the 5 marks. For example, you ignore the commercial acumen, but skepticism and for analysis, you have put huge effort. So maybe you're getting 5 marks.